Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains, and today we're taking a look at three retail stocks to possibly consider buying before their upcoming earnings releases. But before we get into everything, I want to say to remember to subscribe and leave a review wherever you listen to your podcast, and make sure to check out our new Zacks.com/promo page for a look into some of our services, portfolios, and more. All right, so before we jump into our three retail stocks to consider buying before earnings, it's worth just quickly diving into what's going on in the market. And we're going to also take a look at the broader earnings picture to give some more context for what to expect from these three stocks we're talking about today. So stocks jumped to new highs once again on Monday morning, with oil prices and bond yields also heading up. This comes as Wall Street continues to bet that there will be new economic stimulus to help boost the U.S. economy even further as we head out of these winter months soon enough. The climbs also come as the S&P 500 posted its biggest week since November last week. On top of that projected stimulus, investors have also finally started to really appreciate just how strong the earnings results have been so far. We saw all of the big tech giants from Apple to Microsoft to Alphabet all crush their quarterly earnings results and really flex their muscles at just how strong their companies are amid what is still a pretty tough economic environment for many others. So with this in mind, we also saw some other economic bellwethers report stronger than expected earnings results. And now we're going to take a look at the broader S&P 500 earnings picture. This is based on some of the latest Zacks data. So our data now calls for overall Q4 earnings of 2020 to come in positive, which is a big jump over the last several weeks, when even several weeks ago the earnings picture was improving, but we're still calling for negative earnings results or a decline in earnings results. But now we're calling for 2.2% growth on 2.5% revenue growth this year, which would follow a 7% decline in Q3 and a 32% decline in Q2 and a 13% decline in Q1. So it looks like especially on the earnings side, the S&P 500 is going to race back into positivity. Obviously, a lot of this has to do with some of the big tech companies posting really, really strong results that are much better than what we were calling for earlier in the quarter. With this in mind, the Q1 2021 earnings estimates have also continued to get better and better. So if we look back in early December, we were calling for about 12% earnings growth in the first quarter of 2021. And as of this morning, we're calling for about 17% earnings growth in the first quarter of 2021. So you can see just how improved that earnings picture is and how improved the fourth quarter results have come in, and just how much better we're calling for those results. So along with that projected more economic stimulus, the earnings picture continues to paint a pretty bullish outlook for 2021. And with that all said, we're now going to take a look at those three retail stocks to consider buying before their upcoming results. And the first one of those stocks we're going to look at is Sonos, which trades under the ticker SONO. And it is a speaker company that's been on a pretty big ride recently, and it's set to release its first quarter FY 2021 results after the closing bell on Wednesday, February 10th. So after the closing bell this upcoming Wednesday. Sonos is one of the really preeminent home audio companies. It specializes in wireless and multi-room sound systems. Its speakers and sound system are often compared to Bose in terms of quality and price. The Sonos speakers are certainly not what many would consider cheap or anything like that, but they're still rather affordable considering the quality and the important role that these devices now play in most people's homes. They're very easy to use. I actually got one as a gift for Christmas. It's pretty straightforward. The sound quality is really impressive. So they have some baseline smart speakers that start at around $200, so $199, while they also have a range of other products. And one of the biggest things you can buy is a 4-system surround sound offering that can cost all the way up to nearly $2,000 or $1,900. So they also offer pretty sleek, simple designs in both black and white, and they've certainly been able to thrive in a pretty crowded market, as we said, alongside Bose and other titans like Apple and Google. Everyone seems to now be making a smart speaker, obviously Amazon Alexa. So it's worth noting that Sonos has been pretty competitive in a pretty crowded space. So if we look back in November, the company added its new ad-free HD streaming tier to its streaming radio service. So that's Sonos Radio HD. It's going to cost $7.99 a month, and it aims to compete against Spotify and Apple Music and all those countless other offerings in that streaming music tier. So this could be a good growth for Sonos to jump on going forward. And Wall Street has certainly been tuning in again, and the company has continued to benefit from that stay-at-home environment where more people are spending money on products that they see as enhancing their lives when many people are still cooped up inside of their homes. So Sonos posted blowout Q4 2020 results in later November, with sales up about 16%. And then over the course of the year, the firm's total households jumped 20% to about 11 million, with listening hours up over 33% from the year ago. The company also raised its outlook at the time, and Zacks estimates are now calling for its 2021 revenue to jump over 11% to about 1.5 billion, with its 2022 sales expected to come in over 9% above that growth. So some solid top line growth this year and next. And these would come on top of FY20's 5% sales growth and stack up very well against the 11% growth the company did in 2019. And meanwhile, Sonos is also expected to soar from an adjusted loss of 18 cents per share all the way up to 68 cents per share this year, and then climb another 30% on the bottom line. So some impressive bottom line growth as well. Zacks currently has Sonos as a number 3 hold at the moment, and it does hold an A grade for growth in our style score system. As we mentioned, the stock has done very well recently. We should also note that the company went public in 2018. It's now up over 100% in the last 3 months and 125% in the last year. And it recently hit new records, and it has it trading at about $30 per share. So still what many people would consider a quote unquote lower priced stock. And investors should also note that Sonos announced a $50 million share repurchase program late last year. And this is after it completed its previous round of buybacks in the fourth quarter. So certainly a stock worth considering at the moment as a longer term play within a space that's certainly not going to go out of style anytime soon. Those connected home speakers systems, as we said, that's they're been able to do pretty well in a crowded space against some impressive tech titan peers. And as we mentioned, it's trading at about $30 per share, which might make it more enticing for many investors looking to invest in that broader consumer tech space that's only going to grow for years and years to come. Now we're going to move on to another company that's set to report its quarterly results before the market opens on Thursday, February 11th. So this upcoming Thursday, they're going to release their Q4 2020 results, and that is Yeti. They are a pretty high-end cooler company. They trade under the ticker that's their name, YETI. Yeti has come a pretty long way from its founding in 2006 as a niche higher-end cooler company. The Austin, Texas-based firm still sells heavy-duty coolers that can cost up to $1,300. They originally marketed to commercial fishermen and people who really have a vested interest in keeping their products very cold, or whatever they're putting in that cooler very cold. And they've really blown up since 2006. And they've also expanded their offerings and their consumer base with now multiple cooler colors and lines and different shapes and sizes. They also sell tumblers and mugs and dog bowls and much more, to where their cooler business is now taking up less than their other business. So Yeti's Q3 sales jumped about 30%, which represented its best top-line growth as a public firm. And Wall Street was also once again pleased to see that its drinkware space accounted for nearly 60% of total sales. So as I mentioned, not everyone's always in the market for a cooler. And once you buy a cooler, you're probably not going to buy a $500 cooler all the time. And especially when Yeti's guaranteeing it for a while, and they're pretty heavy duty. So it's nice to see for a company like this that they're able to expand their reach into a more everyday item that people might buy multiple of and give as gifts. Yeti is also definitely part of a higher end retail group that's been able to succeed in crowded markets and grow their business through online marketing and in our social media age. So this is definitely, you could consider them along the lines of Lululemon and Peloton and Canada Goose and all those other higher end, what you'd say are newer retail brands that have kind of upstaged some of the legacy brands. And Yeti is also focused on its e-commerce business, obviously, and it's slowly expanding its brick and mortar footprint. Wall Street has also certainly rewarded the stock. It's been on a massive run over the last 2 years. It's up about 320%. This includes a 110% jump in the past year and about a 50% climb in the past 3 months. Yeti is currently trading right near its recent highs at around $76 per share, which comes in just below its mid-January records of about $80 per share heading into its release. Yeti is also trading at a pretty solid discount compared to Lululemon in terms of forward sales and earnings, and the stock grabs an A grade for growth. And we should also note that its leisure and recreational product space sits in the top 9% of over 250 Zacks industries. So with this in mind, our current estimates are calling for its Q4 sales to jump about 17%, with its bottom line expected to climb over 31%. This would help its full year 2020 sales jump over 16% to about $1.1 billion, with its adjusted earnings expected to climb about 47%. And then we're calling for another 15% top line growth in 2021 and another 18% growth on the bottom line. So this growth would come on top of 17% sales growth that it did in 2019. So some steady 3 straight years of 17% growth. Then we're calling for about over 16% growth and then another 15% growth in 2021. So 3 straight years of solid growth for Yeti is what we're calling for. And Yeti's strong earnings revisions help it earn a Zacks rank number 2 buy right now heading into its quarterly earnings release on Thursday. So it's certainly a stock worth considering, and certainly a stock worth considering as maybe a longer term play on this new retail age, as certainly some of the historic players like Macy's and other department stores fade a little bit as that e-commerce and some standalone brick and mortar businesses prove their strength in 2021. And then we're going to close with a company that's maybe not as new school as Sonos and Yeti, certainly in terms of name, but that is Tempur Sealy, which is that mattress firm. They trade under the ticker TPX, and the company will release its Q4 results before the opening bell on Thursday, February 11th. So right when Yeti does as well. Tempur Sealy is one of the world's largest mattress and bedding companies, and it sells everything from mattresses and pillows and everything else that you'd think of as a mattress store under different brands. That includes Tempur, Tempur-Pedic, Sealy, Stearns & Foster. So many different offerings. The company has, like many other companies, ramped up its digital and direct-to-consumer businesses. In the Amazon age, where now everyone wants to be able to buy something without going into a store ever, just get it delivered directly to their house. And they're also doing this as more of these newcomer mattress firms, those bed-in-the-box firms like Casper and Lisa and others, draw that millennial customer, those younger customers. So Tempur Sealy's certainly improved its digital and direct-to-consumer business. They also still work with third-party retailers like Mattress Firm and Big Lots, and they own their own stores as well. So with that said, amid all of this online competition, it is worth noting that Tempur-Pedic continues to be really highly rated in terms of satisfaction by J.D. Power and other outlets. So with more options seemingly than ever to buy a mattress online, Tempur Sealy might be able to stand out in the long term by having these really well-made mattresses. So prior to the pandemic, the company had grown for its sales for 8 straight quarters, and this included a 19% climb in the first quarter of 2020, and then a nearly 30% climb back in the fourth quarter of 2019. So it had been on a really nice run. Its sales then dipped 8% in the second quarter, with its stores shut down in many places around the country, and the world was obviously impacted by that coronavirus environment where people weren't going in and people weren't necessarily making the biggest purchases right when all of this chaos was happening. With that said, the company then beat our Q3 results with its sales up a whopping 39%. So looking ahead, we're calling for its upcoming sales results to jump 13%, with its adjusted earnings expected to climb 53%. 3%. So overall, its current year sales are expected to climb 16%, and then 75% growth on the bottom line, and then another 8.4% growth next year, and another 14% growth on the bottom line. So once again, another retail company that's expected to do strong year-over-year growth both this year and next. And more broadly, the company certainly stands to benefit from that booming housing market that has more and more people buying homes to look for more space. 2020 was a blowout year for home sales. And it's also worth noting that on top of the coronavirus inspiring people to maybe get more space or move, the market is now firmly being driven by millennial buyers as they reach those prime ages of buying a home and starting a family. So this could certainly keep the home buying market humming for years. And if you're buying a home, lots of people also probably consider buying a bed in those different home projects as well. So the company is part of a retail and home furnishing market that includes RH, Ethan Allen, and some others, and it sits in the top 20% of our more than 250 Zacks industries at the moment. It's also trading at a discount compared to its highly ranked industry. It's trading at about 14 times forward earnings versus its industry's 19 times average. It's also coming in right near its own 1-year median. The company is currently a Zacks rank number 3 hold heading into its Q4 release, and it sports an A grade for growth and an A grade for value in our style score system. And we should note that TPX stock is up about 30% in the last year, and it's also up about 20% in the last 3 months, and it's currently sitting right near its recent records at around $29 per share. So along with Sonos, it's a stock that others might consider to be within that cheaper price range. So as a retail play, that certainly mattresses aren't going out of style anytime soon. And as we mentioned, it has a lot of brands that are going to be able to compete long-term within a crowded space. It might be worth considering as a longer-term play. To mention, with all of these stocks, in the near term, if you're trying to play these stocks for short-term gains, it's always much more of a bet than long-term investing for any of these 3 stocks. Certainly with a lot of them doing so well in the lead up to their earnings reports, you could see maybe some near-term selling as investors take profits. But as I said, with the broader earnings picture, companies have blown out their quarterly earnings, and investors are now pushing stock prices back up to new highs on the back of this stimulus and earnings positivity. So it could be another big week for any one of these 3 retail stocks. They certainly do look worth considering as longer term plays for Sonos, Yeti, and Tempur Sealy. So that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.